Hello and welcome everyone to another Q&A session. Matt Townsend's joining me to go over some of the questions that you had for this week. And of course, my son Tyler is producing the video, so thanks Tyler ahead of time. So we got a number of questions in here. I'm going to go ahead and take those questions from Matt and try to get your questions answered. These questions obviously will be time stamped, and then you can come back and look at your question. We'll make sure that we get out the answers to each individual member that asked the question. But the reason that we do this is hopefully a lot of members will benefit from the questions that are asked by the group. So I'm sure there are a lot of folks out there that have similar questions to the ones that are asked by other members. So this way we can get it out to everybody, try to make it a little bit more scalable. So with that, I'm going to move my screen and we'll get this thing started. But Matt, what's the first question you got there?
Tom, thanks for having me on again.
Yeah.
Great to do another show with you. So we got a first question from GW. How do you get the CPCE 5-day and 253-day EMA saved into your stock charts?
Okay. There's a couple of different ways you can do it. I've got the S&P 500 on this chart. This is just my default chart, so I was going to show you how I do it. But if you come down to the bottom and you look down under the indicators, you can put in price, change it to price, put in the CP $CPCE. I usually will go into the height, make it larger, put in an overlay for a simple moving average, and it comes up 50 as a default. I just get rid of the 50, and that's 5. And then under here, under the style, instead of just leaving it on auto, go all the way toward the bottom and hit invisible. So what that does is it gets rid of all of the intraday, each day's candle, and just gives us, the only thing that'll show up is this overlay. So I will go ahead and click this update, and you can see down here on the bottom, I've got the 5-day equity only put call ratio. Right now it's sitting at 0.546. And the whole purpose of this and what we look for is that when things start to get more pessimistic, a lot more retail traders will buy puts rather than calls. So we start seeing a shift in sentiment, and it's puts divided by calls. So the number goes up, the more bearish the market gets. So if you look back to July and August, you'll see this kind of ABC correction. And at the bottom in early August, you can see that's just about the time that we, go to a 1-year high in terms of the 5-day moving average. That's telling us that things are getting really, really bearish. And usually I'm looking for some sort of reversal off of that. So we saw it here and we bounced, saw it right here at this low, we bounced, saw it right here at this low, we bounced. Now, that's from a pessimistic standpoint, and I think the market reacts more to overly pessimistic than it does to overly complacent or overly bullish, overly confident in the market. But when you get 5-day readings that are down at the lows, that's when you have the possibility, at least, that's one signal that I would be looking for a potential top. Now, if you look at where we've gone, normally if you get down to about 0.55, you can see here we had a little bit of at least back and forth action. Here in May, we got down to 0.55, and you can see that just about coincided with a short-term top before we rolled over. Then we had July. You can see this 5-day moving average gets below 0.55 almost immediately at the top here as that comes rolling over. And then for like the last 4 months, we've kind of just been hovering in this area right at about 0.55. And if you look at the market itself, you can see the last 3 or 4 months, last 3 months from the high in early November, we really haven't gone anywhere. It's been a lot more of this back and forth action. And I think a lot of that is because of the complacency in the market. Now, these levels that we're seeing right now are not nearly as complacent, not nearly as bullish. The retail traders in the options world were not nearly as bullish as they were, say, back at the end of 2021. We routinely had a lot of readings in the low to mid 40s, like 0.40 and so forth. And so, this it's concerning me, but it's not like I feel like we're going to go into a cyclical bear market. So anyhow, that's just kind of how I view the 200, or excuse me, the 5-day moving average. It's a short-term indicator, just looking for, just trying to help us in terms of trying to figure out whether we might be at a short-term top or bottom. Now, to do the 253-day, you'd basically just do the same thing, except here, instead of 5-day, it's 253-day. And it probably doesn't make a whole lot of sense to have a daily chart up here with this. So I would say, or certainly not a 1-year chart. You can have a daily chart, but you'd want to go back, I'm going to say 15 years, and we'll make it a weekly chart. Probably could do, we'll just leave it at that. And you can see the different moves. Actually, I think the way I do it is leave it as a daily chart. So let me do that. Yeah, so here are the ups and downs long term. So here you don't see the back and forth, many times within a year. Here you're seeing just major long-term signals. And so when the 1 year or 253-day, that's the equivalent of 1 year, that's trading days. And there's about 253 trading days in a year. So this is the 1 year moving average. And you can see when we get to tops, that means the market has really shifted to a very, very bearish feeling in the market. So this normally is going to come at the end of cyclical bear markets, secular bear markets, and so forth. So in 2022, you can see that we had this down move in the S&P 500 just as this complacency started to turn up. So we'd had a lot of folks just betting about the market going up, up, up. And you can see where we stood back then on a 253-day moving average basis. And look at what happened at the market at that top. Right at this bottom here was the top in the S&P. And this was one of the biggest problems that the market had going into 2022. Right now, we topped in this reading in 2023 after we went through all the inflation and everybody was so bearish and nobody thought we would go back even to test the recent highs, much less go to all-time highs. But sentiment told me that we were completely sold out, that the market was so fearful. Anybody who wanted to sell had already sold. And so that just leaves folks with stronger hands that are buying, usually institutions. And so as that happens, slowly you start getting into a market as it keeps going higher and higher, where all of a sudden people aren't quite as gloom and doom. And now they're starting to feel like, oh, now, the market's is going to do well. And we're going to get to a point at some point where we're going to make a big turn. Now you can see in 2011, we turned with this 253-day moving average at 0.58. In 2014, we turned when it was at about 0.58. Just below, probably about 0.61 in 2018. And then here was when we were just extremely complacent. But the thing to understand is when we are in a strong downtrend in this 253-day moving average, that's when the market does its best work. I always say coming out of a cyclical bear market, somebody asked me one time, what's the reason, what's the purpose of trying to call a bottom? And I'm just thinking to myself, are you kidding me? I think the purpose is pretty clear. You try to call a bottom, you look at all your signals, because if you get the bottom, history tells us that the best time to be in the stock market is coming off of these bottoms, not waiting a year or two for everything to all of a sudden be peachy again. Then you're going to be getting in probably just before the next cyclical bear market or correction. You want to get in when the market is starting to tell you that things are turning. And we've gone too far in terms of the sentiment, too much bearish sentiment. That's when you want to get in. Middle of 2016 right here is when we peaked and started to roll over. If you got in here before that breakout, you would have had a nice huge ride here over the next couple of years. Probably 50% on the S&P 500 in less than 2 years, or roughly 2 years. So that's what you want to be in. That's what you want to look for. Right now, we're still downtrending. That's why I still feel like you don't really want to bet too much against the secular bull market, but you can still have cyclical bear markets that do happen during these longer term phases. I mean, we saw that in 2020 with the pandemic. So we were still on our way down. We bounced a little bit in fear because of the pandemic, but we kept going lower and lower and lower till we finally reached this crazy low back in 2021. Anyhow, little bit longer explanation, but I want to make sure everybody understands how we tie in sentiment to the overall market, because the short-term moving average doesn't tell us that a secular bear market's coming. It doesn't tell us that, now get out of everything and think about shorting. All it's telling us right now is it's just giving us a little bit of a warning that, hey, market could be toppy. And I think, again, that's why we've seen the market struggle over these last 2 to 3 months, is because we've had a lot of complacency in the market already. The 253-day moving average is much more of a long-term call. What you got next, Matt?
So we're actually going to stick on the same chart, going back to the 5-day SMA. I think you did a great job explaining, but just to go back and clarify, we have Monty that says he's never traded options before. And he doesn't know what you mean by complacent, bullish, bearish, more aggressive, if you will. For all I know, these terms to an option trader mean the exact opposite that I'm understanding them. And he was also wondering what the red circles meant on your CPCE chart.
Okay.
I think you did that in a weekly market report recently.
Yeah.
I think you just explained it.
Okay, yeah, I generally point that out on the weekly. That's kind of a weekly ritual that I do. I always want to follow sentiment, and so I always like to talk about that. I mean, the red circles are basically what I was just talking about. When we reach peaks and when we reach valleys. Actually, when we reach a peak up here, I'm bullish. So usually I'll use green arrows or green circles, because anytime you get up here, that's much more bullish for the market, meaning that sentiment is telling us things are so bearish, and that's usually when the market bottoms. So high sentiment readings or bearish sentiment, like extreme, are generally bullish for the market. Whereas when you get too low, it's meaning that there are a lot more calls being traded. Calls, think about calls being like leveraged ETFs. I talk about the IWM when the market's going up. IWM does, well. But if you're in the TNA, which is a 3 times leverage of the IWM, you're going to do 3 times as good to the upside. Well, options they're obviously a different animal. They've got expiration, they've got strike prices, they've got lots of different things. But essentially, when you're in a call option, if you buy a call option, it's giving you leverage. So one call option equals 100 shares of a stock price. So if you buy 10 calls, you're controlling 1,000 shares. And if it goes up, you're going to make a lot more money on a percentage basis on the options than if you traded the stock itself. But you're also going these options expire, and if they go against you, they could be worthless. So they're very, very aggressive means of trying to trade the market to the upside or downside, or an individual stock to the upside or downside. So when I circle these down at the low end, that means there's a lot more calls being bought than puts, which means that the overall market is much more bullish, thinking that the market has to go higher. They're convinced it's going to go higher. Well, this is the sentiment that gets the market in trouble. When we get too much of this for too long, and you can see we're remaining pretty low over the last year. Now, again, if we go back, 5 years, you'll see that back before the pandemic, this was 2020 through 2021. I mean, this was a year and a half of just crazy readings, many down at 0.4, and we actually even went down a little bit below. So that was the lowest readings that we've ever seen, or at least that I've ever seen. And that's because people unwound. They were very bearish when the pandemic first hit, but when they saw the market keep going up, everybody was making money hand over fist. They just kept trading options. They thought the market was an ATM machine. And so everybody that got in, especially new traders that had no prior experience in the market, they were buying these calls left and right because they could make money quick. Greedy. And when you get the market that gets to that point where it's so greedy, you better buckle up. Now, we're not there yet. We're heading down there. And I always talk about sentiment resetting. When you're too bullish, it needs to reset. Market needs to come down. Fear needs to go up. And then you go from, crazy bearish, to crazy fearful, and that marks bottoms. And then you need this to reset coming down. And as it comes down, more people get more bullish and the market goes up until you reach these extremes. So the circles that I use generally are used to identify some of these extremes and why I believe the market could be based on this signal. Now remember, this is just one signal. It's one sentiment signal. It doesn't mean that when I see this thing, hit a certain level, that this is all I pay attention to. It's a secondary indicator. Primary indicator, there's only one of them. It's the combination of price and volume. Nothing else is close to price volume. If the market's going up, you should be thinking bullish things. If it's trending up, then we're bullish. If it's trending down, then we're bearish. These signals, these secondary signals, when they all start to come together, start to build a case for why the price volume could change. But even still, and that's what I said back at the beginning of 2022, I was providing all these reasons why I thought we could go into a secular bear market in 2022. But I said, first, we've got to see the breakdowns. The price has to confirm. So you could take a chance and say, well, with all these negative signals, I'm going to get out at the top of the 2022 bull market. And that would have been great in hindsight, but it didn't have to work out that way. It could have gone a lot of different ways. But once we started getting price breakdowns that confirmed all the signals, the secondary signals, that's when it was like, okay, game on to the downside. So anyway, hopefully that helps explain it a little bit for you.
Yeah, that was an awesome clarification. And then just another thing for this same chart, what do you consider a reset for that 5-day? Remember you mentioned that, like you said. Yeah. Yeah. So go ahead.
Yeah, I don't really have a target on a reset. I just look for it to bounce. I look for the market to sell off for a period of time. Sometimes you get these readings down at 0.50 on the 5-day moving average. It could be the start of just maybe a 1 or 2% decline in the market. It could be the start of a 5% decline. It could be the start of a correction. It could be the start of a cyclical bear market. We don't know. It's based on other signals as well. If that's the only one that I really am looking at that worries me, then I'm usually just looking for a very quick pullback. And then, we're right back at it again. If you look at this, we get these low readings and we bounce, and then we come right back down to these low readings. It's up and down. It looks a little bit like an EKG, although that might be a little bit too crazy for EKG.
Not very healthy.
Yeah, you might want to go to a cardiologist specialist. But that's the way the sentiment works. I just think in the near term, because of our market maker system, most people, when they buy and sell calls, the options market is not as liquid as the stock market. So when you go to buy or sell a stock, if you want to buy Apple, there's plenty of people on the other side that'll sell Apple. When you go into options, specifically certain strike prices and so forth, there may not be somebody on the other side. There probably won't be somebody on the other side that wants to sell exactly what you're buying. And so most of the other sides of these individual stock options are market makers taking the opposite side of what you're doing. And so if the stock keeps going up more, you're making money. Well, guess what? Market makers are probably protecting themselves by buying the underlying stock. If you're buying calls, what the market maker should be doing is selling those calls to you, but then also buying the underlying stock, which is called a covered call strategy. They can't really lose money doing this. If market keeps going up, they're making money on the stock as it keeps going up. They end up making a little bit of money on the premium because they're losing on the option. So whatever the premium was, they end up making money on it. You got to go through a course. Honestly, I don't want to turn this into an options education session, but there are reasons why these different signals work. And again, most of the time when you get extreme readings, just keep in mind you got market makers on the other side, and they would love nothing better than for price to snap back and move the other way. And they've got a lot more resources and capital than we've got in terms of the money. Think about these big firms, Goldman Sachs and so forth. We're talking about trillions, of capital available. Maybe some of the firms billions, but you get my point. I don't have billions. I don't think anyone else I'm talking to has billions, but maybe if you do, congratulations. But anyway, that's kind of what we look for there.
Awesome. All right, so moving on. We're finally getting off that chart. Tom, could you take a look at Uber for Manny?
All right. I'm going to tell you in the short term, I'm a more of a momentum trader generally. I don't like the AD line going straight down, being at a 52-week low. That tells me the stock generally is not doing well in the afternoons. And that's not a good sign. That to me seems like distribution. And that's what the AD line is telling me. I look at the price chart and I don't see anything really different. I see, we topped on the AD line about where we topped on the price. AD line keeps dropping. Price has even rebounded in the month or during 2025 so far. And yet, for the most part, AD line keeps going down. So I feel like any kind of move to the upside at this point is just it's more manipulation than anything. So I'm not really liking it. But if we go on and take a look, say, at a weekly chart here on Uber, you see a different story. You got an uptrending stock. I think the most recent low, we got a series of higher highs, higher lows. This is the last higher low. That's at 55. So I think from a longer term perspective, as long as Uber stays above 55, I'm okay with it. I kind of look at this as just sideways consolidation. Now it is, there's a wide range of consolidation. So you got to, buckle up on a stock like Uber. But I think right now the biggest support level is 55. The biggest resistance level is 86. And I think you can probably go to the daily chart between those two levels and kind of look for short-term trends. But the long-term trend, I believe, ultimately, Uber breaks out. But that doesn't mean it doesn't go to 55 first and test the bottom. So it's just not a stock I'm interested in right now.
All right, so we got a question on David Keller technical strategy. It's from Larry. Larry said he was listening to David the other day, and the options guy who technically buy call spreads. He says he likes to buy when RSI goes through 30 and then back through 30 when there is a MACD crossover.
Okay, let me look at that chart or a chart. I just pulling up Chipotle. To kind of look at. So here's MACD and PPO. If you look at it with the naked eye, I mean, you're not going to see a difference. So I think on a daily 1 year chart, doesn't matter which one you use. They're going to look very, very similar. In fact, if you want to, let me show you this. So I'll pull up the MACD and I'm going to put it up there above the price chart, but below the PPO, just so you can see what this looks like. Here's the PPO on top. Here's the MACD. So let me know if you can see any differences in it. It looks exactly the same. But the PPO is based on price percentage difference, and the MACD is based on dollar percentage difference between two exponential moving averages, the 12 and 26 day, or 12 and 26 period, depending on what chart you're looking at. That's the default reading. So when you talk about crossovers, there's two different kinds of crossovers that I look at with PPO and MACD. One is the trigger going through its 9-day moving average. So that's just lagging behind the thick black line that you see. So if I go through here, you can kind of see that thick black line, prices going down, down, down. Short-term moving average is pulling away from the long-term moving average. And then at some point when you start to consolidate, the 26-day moving average starts to play catch up to the 12-day moving average, and that's what triggers a crossover over your 9-day moving average. Now, that doesn't mean that you're necessarily going and you're really bullish. It just means that the movement to the downside is slowing. So I think a lot of people get this wrong and think, oh, you're getting a crossover. Oh, man, the momentum is picking up. Well, I want you to look at what's going on here. Here, we went down for what? I don't know, looks like 4 weeks almost consistently straight down, probably 6 weeks from the top to the bottom here. We go up for 3 days and we get this crossover. Now, if you had bought the day that this crossed over, I would argue you would have bought the first day of August, probably right near the high. And look at what happened the next 2 days. Chipotle was down from this high, which was at 55, to opening this day at 48. So 2 days later, you'd have been $7 down. Doesn't seem, and at a new low, by the way, when you got this open. Doesn't seem, now that was a kind of a weird period too, by the way. That was back when the small caps took a tumble. Small, mid caps, everything took a tumble, but especially small and mid cap stocks. And CMG took a tumble. But my point here is, this doesn't always mean, I don't think trading is a good idea where you just buy when this line crosses this line. I mean, that just doesn't make any sense to me whatsoever. There's no rationale. There's no common sense to it. And you can see, I just pointed out what would have happened here. I probably would have gotten stopped out. I'd have been out down $7 in a little over a day, which wasn't good. Now, if you decided to hold on as you get further and further up here, you get all the way back to the center line, which here, if you had held all the way to here, and then it looks like it's kind of rolling back over and trying to go negative again. And if you look at where during all of this movement to the upside, from right here where we cross over all the way to the top and starting to roll over, price action at the top or at the crossover was at 55, right? Right here as we crossed over. If you held it all the way until when it looked like it was falling apart, it would have been back down below 55. So all of this move up in the PPO essentially resulted in nothing in stock price. You don't have bullish momentum until you cross what I feel is the more important crossover, which is the center line. Because at that point, your 12-day moving average has moved through your 26-day moving average, and now you've got bullish momentum. Your short term is actually above your longer term moving average. When you've got a PPO or MACD below zero, you're still below. Your short term moving average is below the long term moving average. So it doesn't cross back through and actually start to show something good until you go through the center line. So I prefer center line crossovers than to just regular crossovers of the trigger line or of its 9-day moving average. And so that's one distinction. You'd have to just kind of figure out. I don't know which one the options guy was talking about. But there are a lot of traders that like this crossover. I'm not saying, and maybe it works for them. I've just found too many instances where you get a crossover very briefly because on the way down, you can have a little flag. And during that flag, what happens? You consolidate. What happens when you consolidate? The 26-day moving average starts to catch up with the 12-day. And when that happens, you start to get a little bit of strength in the PPO or MACD, and you get this crossover. And meanwhile, in a flag, what you should be expecting is another move to the downside. Now, part of what is helping the market overall is that we're in a secular bull market. So if we were in a secular bear market, I can promise you, or even a cyclical bear market, I can promise you every time you get a crossover from underneath, that's the time to sell, not to buy. So anyway, those are just some of my thoughts on it. I don't use the RSI crossover or the MACD crossover as much. I still feel like, I want to trade momentum. So for me to feel like a stock's got positive momentum, a couple things has to happen. Number one, PPO generally is going to have to be positive. I'm not going to feel great about the momentum on a stock to the upside if the short-term moving average is still below the long-term moving average. That just is setting you up for maybe rolling over again to the downside. So I need to see a breakout. I need to see price breakout. I need to see the PPO crossover or MACD into positive territory. And I really want to see that RSI move through 60 because in a downtrend, the RSI usually caps at about 60 and rolls back over. So once you get up through 60 and get closer to 70, you get the PPO turning positive. That is more of a stock that I'm going to be apt to trade at some point down the road because now it's starting to show bullish momentum. Now, it could be that the group is just exploding to the upside. Maybe the restaurants are exploding. Chipotle may still be a laggard within restaurants. So the other thing I would want to put on a chart would be a relative strength indicator to make sure I'm getting a leading stock in that group. What could be happening is that maybe Starbucks is doing better, or maybe it's McDonald's, maybe it's Brinker, EAT, which has been going crazy of late. But just because you're looking at this chart and it's doing something, it doesn't mean it's best to breed or best in its peer group. So there's so many things that go into trading, but just to say that this line crosses this line and I'm going to buy, especially in options, no thank you. Not the way I trade. Again, if you can do that and make money, more power to you, do it. I say trade, use whatever works. But that to me is a recipe for disaster, especially if you haven't been trading options for a long time and you're not familiar with them, you're not educated in that area. I think that could be a big, big mistake. Next up.
All right. Next, we got a Max Payne question. and you'll remember
Okay.
Jason. He said I was looking for a video to explain Max Payne, but maybe we can just get a quick rundown of how you do Max Payne analysis.
Okay. Well, I showed you the options, the CPCE, the 5 day, and talked a little bit about the calls and puts and what the calls are and what the puts are. Max Payne, the thing that's critical about Max Payne is that there is the third Friday of every month, monthly options expire. If you own a stock, there's no expiration date. I mean, if you got some food in the refrigerator and it says, here's your expiration date, and you eat it 2 years after expiration, that's taking a really big risk, because normally you don't want to eat foods that are past expiration. So they put a certain date on it to tell you when that food may not be good. Well, in the stock market, and maybe it's not a perfect analogy, but you have expiration dates on options. That is when you either have to exercise them. So if you own a call, you have to buy 100 shares at your strike price that you bought at. If it's a put, you're selling at that strike price. If you have 10 calls, you're buying 1,000 shares. Well, if you buy something like you buy 10 puts or 10 calls on a stock like ServiceNow, which is $1,000 stock. You got 10 calls. You got to put up 1,000. You got to buy 100 share or 1,000 shares of a stock that's $1,000 per share. So I don't know about you all, but I'm probably wouldn't be exercising those. So I'm just going to close out the position. But the whole idea with Max Payne is it looks at all of these various stocks, all of the major indices, the ETFs, and it says, okay, they're going to expire on the third Friday of this month. And if there's a lot of in the money premium, in other words, let's say on ServiceNow, there's a lot of calls at 950 and the stock is trading at 1,000 and there's not many options at other strike prices. It would behoove market makers in a perfect world. It would behoove market makers to bring now back down, to use their capital to short now, to bring it back down to 950 in order to wipe out all that premium. Remember, when people buy calls, market makers are on the other side shorting them. They're selling. So as a price goes from say 950 to 1,000 on stock, people keep buying calls, and then you get to the point where, okay, now we're only a week from options expiration. Market makers are protected if it keeps going up. Remember, I talked about if somebody buys call and the market maker sells those calls, they should buy the underlying stock. So if it's 10, somebody buys 10 calls on ServiceNow at 950, market makers sell those 10 calls, and then they also buy 1,000 shares. They will buy the 1,000 shares of those, that's related to those 10 calls. And so if the price keeps going up, they own 1,000 shares. So they're going up with price. They're not losing on that. But as it gets closer to options expiration, what happens if they start to sell their position that they bought, get rid of their 1,000 shares, and then actually start shorting the stock? What happens? Well, they sell the stock that they had bought to cover themselves. That they made money on that. Then they short the stock, try to use their resources to short the stock to bring the price back down. They make money on that. And at the same time, they wipe out your call that you bought at 950. And all of a sudden you were up at 1,000, you were 50 in the money. And then heading into options expiration, all of a sudden the carpet gets pulled out from under you, and you lose those $50 in the money. So the market maker wins on the way up, wins on the way down, and then, sorry for the language, but basically screws you out of your option premium. They win, win, win. That's why you got to be careful about market makers the week of options expiration, and even into the week, or excuse me, into the 1 or 2 days into the following week, because some people will exercise those calls and puts, meaning that they still have those long or short positions, and the market makers are on the other side of those trades still past option expiration date. Anyway, I would just suggest you join us for one of our monthly Max Pain sessions. I try to go over some of the basics of each one of those. And I think going to it periodically, each month, I think you'll pick up more and more and more. And you'll also see how it's worked. Like here back in November, you can see that right after the election. Remember, the market took off to the upside. We had the big gap up. We went from, on the spider, we went up from 570, 575 up to about 600. And then we went into option expiration week and we had all these in the money call options. Look what happened to the spider over the
I
next
actually
4 days during option expiration week. We went back down. Now, we didn't go all the way down to where I had calculated max pain, which was 570, but that's not what I'm looking for. If you go to these sessions, what I talk about is max pain gives us a directional clue. That's it. So we're sitting at 584 or whatever it was on the spider. What I would have talked about, or not there, up here, almost 600 on the spider. And what I would have been talking about is, hey, all Max Payne's telling me is that we could get a pullback. Now, if you decide you want to buy the spider at 600 or 598 or whatever it is, feel free. But in my opinion, it's too risky. I would rather wait to see if we get that pullback. Then we get the pullback, then use that to get into the SPY. So it's just, Max Payne is nothing different than anything else we do at Earnings Beats. It's all about managing risk, evaluating risk, and trying to manage it with your trades. Not easy, but it's really hard if you don't know about all of these risks. At least if you know about them, you can start to help protect yourself against them. Anyway, I hope that helps. Next up.
Well said. Well said. Yeah, that November example was a great one. I think we had all across our major indices, at least a 6% drop, calculated. But it was correct directionally. It's a beautiful tool when it works.
It is a good tool.
So next we got a scanning question from Jay. He's wondering if you can set up a scan that finds a positive or high slope on accumulation distribution line.
Yeah. Well, I mean, if you look at the AD line, it goes up or down, but there are no values. So I talked to Bill Shelby, who is one of the smartest folks over at Stock Charts. I think I know he's retired now. Still works, I think, part-time. But he basically built the scan engine at Stock Charts. And so I talked to Bill about this a long, long time ago. And he's telling me, there really is no great way to scan for the AD line. And really, it's not, I'm not going to buy a stock just simply based on the AD line. So I would never want to run a scan just based on the AD line. What I'm showing here is kind of something similar. When I do the strong AD chart list and I update it, I first run a scan that looks something similar to this, where I'll look for stocks. It's got to be a stock. I don't want ETFs, nothing like that. It's just stocks. The daily SMA, 50-day of daily volume, I want to make sure it's at least a couple 100,000 shares. So I want to make sure it's liquid. I usually have this parameter in here where it closes above $5. I just don't want to trade stocks under $5. Some do. That's fine. You may only want to trade stocks under $5, which is fine. But that's just not my style. And then what I do is I really want stocks that have good relative strength. And one of the relative strength indicators at Stock Charts is their scooter, which is their Stock Charts technical rank. So it ranks companies based on how they've been performing relative to their moving averages. You could go through and look at the formula. I don't want to spend a whole lot of time on that. But I will tell you, 99.9 is the highest. That generally means you're in a rock solid stock that's going straight up, or down to 0.1, which normally a stock's going straight down if you have a 0.1 rating. So what I try to do, and I don't know why I have scooter over 76. Usually I have something like 75 or 80 or whatever. This was an older one. I don't remember why 76. But what you'll see is sometimes I'll say, give me the scooter score that's greater than 80, which means right now, greater than 80. And then I might go back and say, or the scooter could be greater than 80 22 days ago. And then I might have another one that says, or The scooters greater than 80, 64 days ago. And what I'm doing with those days ago is I'm going back to recent highs on the S&P 500 and essentially saying, this could have been a relative strength stock, a really strong relative strength stock, 3 months ago, 1 month ago, or today. Any of those three time frames, if it met the criteria on either three of those S&P 500 highs, then include it. So it could be a stock that had relative strength 3 months ago, but no longer has great relative strength. Maybe the scooter's back at 60 or 50. I might still like it if the AD line is strong. So this is why I continue to throw those stocks into these different baskets. And then I just say it can be in any of these 11 sectors. I run the scan, and then literally once I run the scan, usually I could have close to 1,000 stocks, sometimes more than 1,000. So I end up having to run this, maybe 5 sectors in one basket and 6 sectors in the other basket, because it won't return all my results if it's more than 1,000. But once I get all these stocks, I put them on Candle Glance, where all I basically look at is price, AD line. And when they come up on Candle Glance, there's a trash can thing, the upper right-hand corner of each chart, where you can just ditch it. And so I look very, very quickly, and generally I want to see going up and up. I usually run like a 6 month. My Candle Glance chart is usually 6 months. And so I can see price action and the AD line for the last 6 months. If they're going up and up together, definitely I'm hanging in there with those. Some might go up in price and then pull back a little bit. The AD goes up and pulls back. I include those. What I don't want to see is the price of a stock going up. That's what's triggering the high scooter score, but the AD line going down. So that's obviously not a strong AD. It's a weak AD. So I hit the delete, the little trash can on each one of the charts that shows something like that. Or maybe the price is going up and AD's just going sideways, up, down, up, down, up, down. Or it's going up and then takes a big tumble and then it comes back a little bit. I don't want any of that. I want price and AD lines going up. And once I get those, that's what you're going to see on the strong AD. So what I would do is rather than run a scan on, trying to run a scan to find strong AD lines, you've already got it. We've already done the research for you. So we can come out here. Let me just pull up anything here and go into the chart list. And right here, if you're a Stock Charts member, extra or pro level, you can take these chart lists that we do, all this research, what I just showed you, that all goes into one chart list, the strong AD chart list. You click on that and you've got everything. Let me, here's the AD line. So here's the first stock. See what I'm talking about? There's the AD line. Now, I did this a couple weeks ago, so some of these could have already started to roll over on ADs, especially with earnings coming out. But essentially, and I don't even know, I should have AD on the top instead of the PPO, because usually the way I like to look at these is this. I don't even care about the PPO when it comes to strong AD. So I've got my strong AD line here, price there. So really all I got to do is look at that. And now if I'll go ahead and apply this style to all. And now I can just flip from chart to chart. And you can kind of see now here, I would have done this back around the 15th of the month. Obviously, it was very strong. But here with earnings, I guess AGX has pulled back. Actually, it's down near a pretty interesting support level right in here. AD line is actually above where it was a month ago. This one's slightly below. So, I mean, something like this could actually be a possible trade with a very tight stop, because if you go below these lows, I would simply get out. AI, yeah, this one was pretty strong, and it pulled back a little bit when I included it, and it's continued to go down a little. But again, when you go through most of these, you're going to see that AD line. Actually, there was Astera Labs, this another one of these AI stocks that got rattled on Monday, coming roaring back. But just about every one of these that you go through should show a pretty strong AD line at the top here. Now, this one topped, and it's been sideways consolidating, so I gave it a little bit of leeway because the AD line was kind of consolidating as well. But I still like this. This is a really nice long-term uptrend here for Allison Transmission. So now you've already got the chart list. So now what you could do is you could go in and say, you could go into the scanning I'll look at some scans. Let me see. 20-day EMA in a rising trend. I don't even know what that is, but I'm getting a 20-day test. I can edit that scan. So it's the daily 20-day EMA is greater than the 50-day. And the open today is above the 20-day. And the close, or no, and the daily low is less than the 20-day. And now the close is back above. So if you can picture this, what I'm looking for on this scan is a stock that has the 20-day above the 50-day. So that generally is an uptrending stock. It also shows price today of a open above the 20, an intraday move below the 20, and now it's back up above the 20-day. This is a good afternoon scan to run. And it also is a scan that you could run against the strong AD list. Remember, you don't have to scan the universe. You can scan our chart lists. So we know if you're a big fan of the AD list, here's a stock that's testing the 20-day that's on the strong AD chart list. And so now I could run the scan and just see if there are any on here. And there are 8. So here are 8 stocks on the strong AD chart list that are showing an open above the 20, a tail below, and an open above, or a close current price, which is back above. So I haven't looked at any of these, but here's one. This is a 20-day. Look at the bounce off the 20-day. Remember, strong ADs are generally because you close better in the afternoon than you open. You might be weak in the morning and then you come back. So you look at this chart on, here, weakness in the morning, and now we're coming back. Here was weakness in the morning, we came back. Look at the afternoon session finish here. This was 2 days ago. Here was the session, well, we went down a little bit into the close, but there was your rally in the afternoon. Look at the 4 or 5 days ago, nice afternoon rally. So here we're down early, but we're testing the 20-day. This is a stock that could rally right off. Now let's look at that longer term again, daily. Yeah, I mean, it's trending up above its 20-day. I mean, I haven't really looked at BLFS, but again, these are the kinds of stocks that you're going to find. So again, long-winded answer, but I don't think there's any benefit to try to scan against the AD line because again, if we look at the AD lines right here, there's no numbers. It's just telling you whether you're going up or down. And it just adds on to the prior day, whatever that is. And so there's nothing here. You can't say, well, give me the number this date versus 3 months ago because there are no numbers. So anyway, you just can't scan against the AD line. Next question. I think we got one more, right?
Yeah, we got one more. So we'll do a general one. How do you use RRG from Julius de Kibbenaar? Well, hi, Julius de Kibbenaar from Alan.
Yeah, there was a lot to that question about using software, wasn't that?
Yeah, I'll get into that in a second. But if you could just give a general, viewpoint of RRG, and then I'll ask more specifics. That's cool with you.
Yeah. All right. Let me see here. So let's go back over here and go to the dashboard. This is how you find RRG under Member Tools. Scan down, and there it is. Click on the RRG. And essentially what the RRG does is you pick a benchmark. Now, the benchmark I usually use on just about anything is the S&P 500. But if you wanted to look at specific stocks within an industry group, you could be running it against the industry group as your benchmark. You could use it, I think, versus $1. It's kind of the, you just use 0 kind of as the benchmark. And then if you're above 0 or below 0, you go, in the various quadrants. But I'm going to stick with the S&P 500. And just to, give you a quick little demonstration, I'm going to show you over a 1-year daily period using the other major indices. We're just going to see how other indices rotate relative to the S&P 500. So you save the changes, and here you go. Now I could go back, and sometimes you see these stocks or what indexes in this case going off the chart. So you can come up here. I can do this on a Mac. I'm just squeezing my fingers on the touchpad to go in and out. But stock charts, if you're here and you're looking at the stock charts, you can hit this max button. And so what it's going to do is over the last year, it's going to make sure that all of these indexes stay on the chart. So it never goes off the chart. So there's the max. And now as I go back, what I can do is throughout time, I can look at how different indices are performing relative to the S&P 500. So here, the S&P 500 is going up, and I can tell that by looking at this price chart of the S&P 500 right here. So as we go up, this would have been all the way through, into early mid-December. You can follow what other groups are doing well. And if you just want to look at one in particular, you could go down here and say, well, give me the Dow Jones, which one has been performing better? And you can go back to wherever you want to start. And here is how the Dow Jones is performing. Here the S&P is performing better. Now the Dow's starting to do better. Now the Dow's leading. Now the Dow comes back down, goes a little negative. Now it comes back up. Now it's staying over on the left side. Now it starts to pick up a little steam here. Now the Dow's doing much, much better as we go through November. And one of the reasons is industrials tends to do very well. November is one of the best months of the year, period, for the market, but especially for industrials. And so this is kind of historical. If there was a seasonality chart that you could also do on the RRG, this is how the industrials would look every year in November. That's when they tend to outperform. Then we move into December, we see underperformance. Now we're into the new year. The Dow starts to outperform again, and now it's starting to roll back down. I would argue based on this, maybe the S&P will start to lead, because this is just simply going around and around and around. Dow leads for a while, then the S&P leads, and so forth. But my take on the RRG charts is it's a great visual way to look at relative strength. Even better, I'd say, than looking at I usually use, a stock, the colon, and another stock, or maybe the S&P or its industry group to kind of look at relative strength, see whether it's going up or down. Here, I think it's just more visual. I think it depends on what resonates with you the best. But yeah, I love the RRG. I still, for me, I like using the colon and seeing on a chart the price action. I guess maybe my numbers background, which is something that I get more out of than the visual side of it here. But I think the visual stuff here is brilliant as well. It just depends on how things resonate with each individual. So what was the individual?
Also, the more specific question would be, Alan is holding Microsoft. It's been a major hold for years, and he continues to do so, or intends to continue to do so. Its recent behavior led him to try RRG analysis. He set it to a max for 1 year daily, using a tail length of 5 days. And then he put some peers in it as well. So we got Microsoft, App, PLTR, Duolingo, Docs, PT. Oh, you got it all? Cool. Gotcha.
Yep. Down here.
And then he used the benchmark of software.
Yep.
Okay. So basically, and then he also added this. What I quickly noticed was Microsoft's behavior was like a dog on a 3-foot leash chained to the both 100 momentum and RS. So yeah, he basically is saying there's no difference between that and the software group. What does that mean?
All right, first thing I would do is hit that max again. So what this is telling me is that throughout the course of the last year, there's a lot of room over here to the leading side and very little. So I would say of the stocks you picked, obviously they're all pretty good stocks because they generally don't trail by very much the software index. And usually maybe there's just one that has just gone way over here. But it seems like most of the performance on these stocks that you've selected, that would be my first kind of look at it anyway. And I'm going to go back a year and just slowly go through the year, and you can kind of watch how these various stocks are doing relative to the software index. And so you can see they are staying on that right-hand side a lot, most of them. So these tend, now here's where the outside, this is why the max is way over here. It's APP, that just absolutely is going crazy, and did for a while. But then it'll go through a weakening phase, and now look at it. Now app is all the way back over here, pretty much even at this point, with that software index. And now as we go into the new year, they all seem to be strengthening again, many of them anyway. Now specifically, the question was about Microsoft and why it wasn't really moving. Well, first, let's just zero in on Microsoft. Part of the reason why it's not moving, whoops, let me get back over here again. Part of the reason why it doesn't move much is because some of these other stocks are so volatile. They've created this massive move out here to the right side, and Microsoft never performs like that. Never, it doesn't move as fast as app did, for instance. So with Microsoft being among the least volatile, it's going to be closer to the center line. It's going to hang much closer, and you can kind of see right there, it just does not move much from the center line. So I think that's the question. One reason is that it's not as volatile as these other stocks that you've given me. The other is that it probably is a big component. I don't know what makes up the Dow Jones US software index, but my guess would be that Microsoft would be a heavy component. So it's kind of rotating relative to itself to some degree, which means you wouldn't move at all. But it's not, there are other stocks in it, which makes it move a little bit more. But Microsoft is a $3+ trillion company. I think it's still above 3 trillion, even though it's pulled back some. But anyway, it's a massive company. And so it's just not going to have the volatility that some of these others are going to have. You're talking about app, doesn't show the market cap on here. But if I do app and I get rid of Microsoft and I just do app, look at what app does over the course of the year. I mean, this thing is just crazy. It's when it outperforms, it absolutely crushes the market. And it just looks like it's just starting to escalate here again versus the software group. So anyhow, hopefully that explains it. I think, the whoever asked that question probably answered their own question, because Microsoft is basically it's such a large representation within the software group because of its market cap that it's not going to veer too far from the group itself. Whereas app, which is much smaller percentage of software, when it goes, it just absolutely can explode in both directions versus the software group. So hopefully that answers that question.
Yeah, awesome. I think that's all we got too, Tom.
Okay. Yeah, I appreciate everyone's questions. Hopefully these, answered the questions. Again, took a long time doing it. I just can't seem to do it quickly. But, what we were all about at Earnings Beats is education in addition to guidance and research. And so we want to make sure that our members do get quality education while you're with us. So we want to kind of expand what we were doing with the Q&A. So I really appreciate Matt and Tyler hanging out with me while we go through these questions. Matt will, he gets back to each individual that asks these questions, so for future weeks, what we do is we pile up, we aggregate the questions. Normally we do it on Thursday. We had a couple folks under the weather this week at Earnings Beat, so we end up moving it back a day to Friday. But generally it's going to be Thursday, Friday that we'll try to get these Q&As done. But we'll answer the questions. Tyler will timestamp the video, and then Matt will get back to each individual saying, hey, here is when your video or when your question is answered on the Q&A video with a link. I believe, Matt, you provide the exact time, so they just click on that and go right in.
Exactly.
Okay.
Correct.
So we try to make it as easy as possible to get back to you to say, hey, your question's answered. Check this out. And then the video itself is open with the timestamps for anybody to come in and review the Q&A, see what other members are asking, and hopefully answer some of the questions maybe that each of you have individually. So that's the whole goal. Again, let us know through email. You can contact us at support@earningsbeats.com. But let Matt and the whole gang here at Earnings Beats know what you think of the Q&A and the way we structured it. And hopefully it's a nice value added part of our service. Anyhow, that's it. So thanks again for the questions. And until next week, happy trading, everybody.